This simple, fully automated trading program enables you to maintain a leveraged long-term position in gold, stress-free regardless of market volatility. It does this using option collars. Collars define risk on every position and for the duration of every trading period, without wasting excessive amounts of money on time premium to hedge risk. Here's how a collar works. In this example, we're long one 100-ounce contract of gold at $1,238 per ounce. Contract value, $123,800. At the time this trade was established, the exchange margin requirement to control this position was $6,420. Against our 1238 long, we're going to write a 1-week call at $1,255. On this 1-week call, we're going to collect an average of $6.06 per ounce, or $606 per contract. The only way our 1238 long position can be called away is if the price of gold at expiration in 1 week is above $1,255 per ounce, which would make us $17 per ounce, or $1,700 per contract. Plus, we get to keep the premium from the 1-week call option we wrote against our 1238 long position of $6.06 per ounce, or $606 per contract, bringing the gross profit for the week with gold trading above $1,255 per ounce at expiration of $23.06 per ounce, or $2,306 per 100-ounce contract. Less all costs, which include bid-ask spreads, brokerage, exchange, carrying costs, and regulatory fees, which total $42 on a 100-ounce contract worth $125,500. On the week, if the position was called away at $1,255 per ounce, it would net us, after all costs, $2,264 per contract. Now let's look at the downside risk and how we objectively define it on the trade and for the duration of the trading period. I'm going to play it safe using the historical percentage moves in gold and current market valuation, which at the time of this report was $2,576 per ounce. The greatest weekly range over the last 10 years has been 12.38%, which at $2,576 per ounce translates into $31,881 per contract. The 10-year average weekly range for gold is 2.85%, which at $2,576 per ounce translates into $7,339 per contract. The largest 1-week sell-off in gold since 2014 has been 9.49%. At $2,576 per ounce, this 9.49% decline equates to $24,451 per 100-ounce contract. The 10-year average down-week in gold, 0.67%, or $1,732 per contract. Risking $24,451 in a week on a 100-ounce contract to make a meager $2,264 in weekly net profit certainly wouldn't work for anyone who's trading gold in a portfolio designed to protect and enhance family wealth. But there is a cost-effective solution to objectively control downside risk on this 1238 long position without wasting large amounts of money on time premium to hedge. And it's called a collar. When we lay down a collar, we're going to use the premium we've collected, in this example on the 1255 call we wrote of $6.06 per ounce, or $606 per contract, to offset the majority of our cost to buy a 1235 put to hedge our downside risk. Because this 1235 put is closer to the market, in this example our 1238 long, the time premium for the put is going to cost more. In this example, $8.67 per ounce, or $867 per contract. Here's the math. We're long at $1,238 per ounce. We've written the 1-week call at $1,255. Collected an average of $6.06 per ounce, or $606 per contract. We purchased a 1-week put with a strike of $1,235 an ounce to define our risk. This 1235 1-week put cost us an average of $8.67 per ounce, or $867 per contract. Net time premium paid to define risk on our 1238 per ounce long, an average of $2.61 per ounce, or $261 per contract. Let's look at the risk on this position. If the price of gold immediately drops to and stays at zero, we're long at $1,238 per ounce. Contract value, $123,800. We own the $1,235 put, which gives us the right, without the obligation, to deliver our $1,238 long to the $1,235 put we own. With the price of gold at zero, we deliver our $1,238 long to the $1,235 put we own. Our loss in the position would be defined at $3 per ounce, or $300 per contract, because options objectively define risk. There is absolutely no possibility for order execution slippage, even if the gold market were immediately to gap down by $1,000 per ounce or $100,000 per contract. In this example, the time premium paid to define risk on this trade is the difference between the $6.06 per ounce or $606 per contract that we collected on the 1255 call we wrote against our 1238 long position, and the $8.67 per ounce or $867 per contract we paid for the 1235 put to protect our position, or a total time premium loss on this position of $2.61 per ounce or $261 per contract. And we're going to add this $2.61 per ounce or $261 per contract to the $3 per ounce or $300 per contract loss on the underlying 1238 long, which totals out at $5.61 per ounce, or $561 on the position, plus all costs, which include bid-ask spreads, brokerage, exchange, carrying cost, and regulatory fees, to establish and liquidate the 1255 call, which controlled one 100-ounce contract of gold worth $125,500, the 1235 put, which controlled one 100-ounce contract value $123,500, and to deliver our 1238 long position value $123,800 to our 1235 put at a position value of $123,500. Total face value of all initiated and liquidated positions, $621,800. Total fees, all in, $84, or 0.0135% on the $621,800 in face value on all initiated and liquidated positions. Total loss on the trade, $561. Total costs, all in, $84. Making the maximum possible loss on this position, including all costs, $645. And this would be on an immediate move in gold to zero. I hope you can appreciate, especially given the current fiscal uncertainty, why trading with collars to objectively control risk makes sense. Now let's look at the upside for this collar 1238 long. Let's assume gold rallies to $1,275 an ounce at expiration in 1 week. Our $1,238 long position is going to be called away at $1,255, making us $17 per ounce or $1,700 per contract. We've paid out $2.61 per ounce in option time premium, or $261 per position, to objectively define maximum risk, puts our gross profit at $14.39 per ounce, or $1,439 per position. Total fees all in, $84, leaves a net profit on the week of $1,355. And this $1,355 net was done on a position that had a maximum net risk of $645, with no chance of being stopped out or subjecting you to a margin call. Another huge benefit with exchange-traded contracts that use exchange-traded options to objectively define risk is the exchange sets your margin requirement at whatever the margin is for the 100-ounce gold contract, For example, at the time this trade was done, it was $6,420, or whatever the maximum risk is on the trade, whichever is less. In this example, the maximum defined risk was $645, which was the exchange margin requirement for this trade. Now let's go through some actual examples of weekly 515 collars in gold. This will enable you to see how collars define maximum risk and profit potential on every trade and for the duration of every trading period. In this first example, we're coming in long 100 ounces of gold at $1,238 per ounce. On all positions, we immediately lay down our collar using price orders, matching option pricing to exchange-quoted bid-ask spreads and through multiple firms. Sloppy procedure laying down a collar, for example using market orders, can turn total time premium paid from $2 per position to $5 or more per ounce. The market at expiration settled at $12.48. Neither the $12.55 call or the $12.35 put were exercised and expired worthless. Our $12.38 long was maintained. With a market settle of $12.48, it made us $653 per position on the week, net of all hedge costs and fees. Going into week 2, we're long at $12.48. We immediately worked price orders to lay down our collar. At expiration, the market settled at $12.54. Neither the $12.65 call nor the $12.45 put were exercised, leaving us long with a market at $12.54. Net profit on the week, $378 after all hedge costs and fees, bringing the cumulative net profit per unit up to $1,031. Going into week 3, we're long with a market at $12.54. We immediately worked price orders to lay down our collar. At expiration, the market settled at $12.69.72. Neither the $12.70 call nor the $12.50 put were exercised. Net profit on the week after all hedge costs and fees, $1,351, bringing the cumulative net profit per unit up to $2,382. Going into week 4, we're long with the market at $12.69.72. We immediately worked price orders to lay down our collar. At expiration, the market had settled at $12.42, down $27.72 per ounce, or $2,772 per contract. But because we had our $12.69.72 hedged, it was delivered to our $12.65 put, limiting our loss on the week to $719 net of all hedge costs and fees, bringing the cumulative net gain down to $1,663. We immediately established a new position at $12.42 and laid out our 1-week collar using price orders. At expiration, the market settled at $12.67. Our $12.42 long was called away at $12.55 for a profit of $1,008 on the week net of all hedge costs and fees, bringing the cumulative net profit per unit up to $2,671. We immediately established a new long position at $12.67, lay down our 1-week collar. At expiration, the market settled at $13.17. Our $12.67 long position is called away at $12.80, netting us $1,081 on the week, bringing the cumulative net profit per unit up to $3,752. We established a new long position at $13.17, lay down our 1-week collar. The market settled at $13.25. Neither the $13.30 call or the $13.10 put were exercised, making us $507 net of all hedge costs and fees, bringing the cumulative net profit per unit up to $4,259. We're coming into the next week long at $13.25. We lay down our 1-week collar. At expiration, the market settled at $13.28. Neither the $13.40 call nor the $13.20 put were exercised, making us $24 net of all hedge costs and fees, bringing the cumulative net profit up to $4,283. We're coming into the week long at $13.28. We lay down our 1-week collar. At expiration, the market settled at $13.39. Neither the $13.45 call or the 13.25 put were exercised, netting us $901 on the week, bringing the cumulative net profit per unit up to $5,184. We're coming into the next week long at 13.39. We lay down our 1 week collar. The market settles at 13.82. Our 13.39 long is called away at 13.55, netting us $1,332 on the week, bringing the cumulative total profit per unit up to $6,516. We establish a new long position at 13.82, lay down our 1 week collar. At expiration, the market had settled at 13.33, down $49 per ounce or $4,900 per contract. But our 13.82 long was collared and delivered to the 13.75 put we owned, generating a net loss in the week of $928, including all hedge costs and fees, which put the cumulative net profit per unit at $5,588. We establish a new long position at 13.33, lay down our 1 week collar. The market settled at 12.94, down $39 per ounce or $3,900 per contract. Because our 13.33 long was collared, we delivered our 13.33 long to the 13.30 put we owned, which limited our loss in the week to $598, net of all hedge costs and fees, bringing the cumulative net profit down to $4,990. We established a new long position at 12.94, lay down our 1 week collar. At expiration, the market settled at 13.03. Neither the 13.10 call or the 12.90 put were exercised, netting us $620 on the week, bringing the cumulative net profit up to $5,610. We're coming into the next week long at 13.03. We lay down our 1 week collar. At expiration, the market settled at 13.18. Neither the 13.20 call or the 1300 put were exercised, with this position netting us $1,295 on the week, bringing the cumulative net profit per unit up to $6,905. We're coming into the week long at 13.18. We lay down our 1 week collar. At expiration, the market settled at 12.95, down $23 an ounce or $2,300 per contract. Because our 13.18 was collared, we were able to deliver it to the 13.15 put we owned, limiting our loss, including all hedge costs and fees, to $561, which brought the cumulative net profit per unit down to $6,344. We established a new long position at 12.95, lay down our 1 week collar. At expiration, the market settled at 13.03. Neither the 13.10 call or 12.90 put were exercised, netting us $611 on the week, bringing the cumulative net profit per unit up to $6,955. Now let's compare the performance and risk of an unhedged long-term position in gold versus a long-term position using collars to define risk and profit on every trade and for the duration of every trading period, from December 2013 through November 2024. Gold closed out 2013 at $1,237.58 per ounce. By the 11th of November 2024, it was trading at $2,570.10 per ounce, up $1,332.52 per ounce. We're controlling one 100-ounce contract of gold. Each $1 change in price equals $100. With gold appreciating by $1,332.52 per ounce, the value of a 100-ounce contract increased by $133,252. The highest weekly high to lowest weekly low was $390.003, or $39,003, controlling one unhedged 100-ounce gold contract. To maintain this long-term position with no hedges or defined risk controls in place, you should be prepared to deal with at least $39,003 in risk per 100-ounce contract. You also should be ready to deal with weekly ranges in gold of at least 12.38%, which at November 2024 valuation of $2,570 per ounce equates to $31,881 per 100-ounce contract. And average weekly ranges of at least 2.85%, which equates to $7,339 per contract. Weekly drawdowns in gold have been as high as 9.49%, which at $2,570 per ounce is equivalent to $24,451 per contract. Weekly drawdowns in gold have averaged 0.67%, or at $2,570 per ounce, $1,732 per contract. The minimum you should allocate to capture a long-term move in gold from $2,570 per ounce with no hedges or defined risk strategy in place should be the previous worst-case percentage drawdown, or in this example, $39,003 per 100-ounce contract, plus the maximum margin requirement over the last 10 years for a 100-ounce gold contract of $13,525. Or to maintain this long-term unhedged position responsibly, $52,528 per contract. At $2,570 an ounce, in an unhedged 100-ounce contract with no defined risk strategy in place. To play it safe, I'd allocate $100,000 per contract. This would enable me to sustain a sell-off in gold of $864 per ounce without being subjected to a margin call. Of this $100,000, I would put $80,000 into a 3-month Treasury bill, which currently pays 4.52%, and earn interest on the majority of my balance to maintain this position. With all exchange-traded contracts from Bitcoin to Zinc, the exchange recognizes a short-term Treasury, the same as cash, for satisfying margin requirements and risk. To summarize, on this $100,000 controlling a 100-ounce gold contract at $2,570 per ounce, contract value $257,010, on the leveraged amount of $157,010, there is no interest deducted from your account on this unpaid balance, because it's a futures contract, which is an agreement to buy or sell this 100 ounces of gold on or before a certain date. But you're probably asking, is there liquidity? Absolutely. The metals futures markets are by far the most liquid metals markets on the planet. They enable us in less than 1 second to establish or liquidate a position 23 hours a day. Or you can set it up to take physical delivery of this 100-ounce contract using the same procedure as the 10, 32.15, and 50-ounce contracts. Maintaining this unhedged long-term position forward, I'd expect to go through at least $390 per ounce in abuse or $39,000 per contract within the next 3 to 5 years. But I'd structure my position to withstand a down move of up to $864 an ounce without being subjected to a margin call. On the upside, I expect gold to repeat its past performance, but in less time, making at least $1,332.52 per ounce, or $133,252 per contract within the next 3 to 5 years, plus the Treasury bill interest on the majority of my account balance for the duration of the trade. Or on this long-term position with no defined risk procedure in place, for every dollar I'd have at risk, I'd expect to make at least $3.42, which isn't that great, but it's acceptable given the way this long-term trade is structured and that it wouldn't require any significant amount of time to maintain or monitor. Now let's look at the return on risk during the same period trading the same 100-ounce contract using a weekly 515 collar. Collars are all about objective risk control on every trade and for the duration of every trading period. In this example, trading long only using a weekly 515 collar, it reduces the highest high to lowest low drawdown from $39,003 trading without collars to $10,566 when you're trading with a 515 collar. But there is no free lunch to achieve this 77% reduction in maximum drawdown, and to make yourself immune from being stopped out or subjected to a margin call. It comes at a price. Why? Because we're writing calls against our position to generate option premium to offset the majority of the cost of the puts we're purchasing to hedge our positions. These written calls make the position susceptible to being called away at a profit, and they limit our upside gains. In this example, by writing calls against positions, it reduces upside net profit from $133,252 trading without collars to $77,386 trading with a weekly 515 collar. But I'll take this smaller net gain every week, all week, because during the nearly 600 weeks in this example, I wouldn't have been subjected to weekly abuse of up to $24,451 per contract. Trading with a weekly 515 collar during the same period, the maximum weekly abuse was $1,058, and I was able to maintain positions with a fraction of the margin money, and I never had to worry about being stopped out or being subjected to a margin call. Collared positions are essentially bulletproof, regardless of what fundamentals get thrown at the gold market. Nor would I be subjected to average weekly ranges of 2.85%, which at $2,570 per ounce equates to $7,339 per 100-ounce contract. Trading with collars, because my risk is defined on the trade and for the duration of the trading period, the maximum margin requirement for a 100-ounce position during the nearly 600 weeks represented would have been equivalent to the maximum risk on any position, which in this example was equivalent to $1,058. And again, I want to emphasize, using collars, I have no chance of being stopped out or being subjected to a margin call, even if gold immediately dropped to zero. I have clients that trade gold and other markets long-term both ways. It's your call on what you think works best for you. In this example, allocating $100,000 per 100-ounce contract, being prepared for at least $39,000 in risk, to make $133,252 per contract, or for every dollar at risk, expecting to make $3.42, or allocating $25,000 with anticipated risk of at least $10,566 to make $77,386 per contract, or for every dollar at risk, expecting to make $7.32. Personally, I like defined risk with no chance of being stopped out or having a margin call, which equates to nearly stress-free staying power. In this example, trading the weekly 515 collar, always long a 100-ounce contract to gold, allocating $25,000 per contract, with a defined margin requirement that never can exceed $1,250 per 100-ounce contract, gives me a solid $23,750 in excess margin per contract. In order for me to exhaust this $23,750 in excess margin, I'd have to experience the maximum weekly loss for this program from 2014 through 2024 of $1,058 per contract for 23 consecutive weeks. The average down week for the gold 515 collar between 2014 and 2024 was $684 per contract. In order to exhaust this $23,750 in excess margin, you'd have to experience the average down week for 35 consecutive weeks. Below, the weekly and annual net performance record position trading gold long using a 515 collar from January of 2014. In the second vertical column, you'll find the 515's position at the start of the week. For example, long at 1237.58. In the third vertical column, you'll find the base price, which is nothing more than the position price rounded to the nearest weekly option strike price. For example, coming into the week, we're long at 1237.58. The nearest weekly strike would be 1240. We're going to write a call $15 per ounce higher than the base price at 1255 to collect option time premium. Using this collected time premium, we're going to offset the majority of the cost for the 12.35 put we're purchasing to define risk on our position. At the end of the week, the market settled at 1247.54, increasing the value of our $25,000 start balance by a net of $653.41 on the week, which left the end-of-week liquidation value at $25,653.41. The next vertical column shows the cumulative performance for that year, followed by the cumulative net percentage gain or loss for that year, then cumulative net profit or loss life of program, then current distance from the highest weekly equity high. For example, the week of the 27th of January 2014. The distance from the previous weekly equity high was $721.06. Finally, on the monthly summary line, the maximum life of program drawdown through that month. In this example, $721.06 through January of 2014. For quotes, educational videos, and reports, see the links at the bottom of this page. If you have any questions, please contact me with this page up. I'll answer them and provide supporting links for additional information and/or verification.